You saw the data. Okay, it was a miss, but when you look at even retail sales coming in at the level that they did, that's a fair old clip for what is now the biggest part of the economy, but not fast enough for the economists.
Well, so the latest data just really reinforce the trend that we have been seeing, for some time in China. That's really significant deceleration of the overall economy. The domestic demand has been weakening, and the external demand has been collapsing on the back of the trade war. So definitely, China continues to face significant downward pressure for the economy.
Absolutely, but does this attack on these oil installations in Saudi Arabia, which lift the price of oil up, change anything? I suppose it's going to be contingent on how long the outage is for, and indeed how far oil rises and keeps at those levels, if they're sustainable.
That's exactly right. So, if this is beginning of a long-lasting oil price spike, that again further complicated the task in China as the single largest oil consumer and importer in the world. So sustain the high level of oil price, among other things going on.
It's like an interest rate hike, in a way.
Exactly, yes. It's going to really dramatically increase the cost. There was a scenario in the 1970s when the real economy was sluggish in much of the world, in the US and Europe. Then on top of it, you have Middle Eastern oil price hike. So that created the situation called the stagflation. So really recession, but also high inflation.
Fred, so much uncertainty, so much weakness in the economy. As the data suggested, the PBOC has shown a willingness to step in for further stimulus. How deep is it willing to go? What will it take?
I believe the central bank has been very vigilant and have been quite proactive in responding to changing domestic economic financial conditions and also very challenging external environment. I'm specifically referring to trade war. So they have done, they have taken a number of actions, including the reserve requirement ratio reductions. I view these measures individually and collectively as necessary, but they may not be sufficient to arrest the downward momentum and put the Chinese economy back on track of fast economic growth.
So if conventional fiscal and monetary policies don't work, what will?
Well, so far the focus has been, conventional fiscal policy measures and the monetary policy responses. But bear in mind, China is not just facing a simple cyclical slowdown. China continue to confront a number of structural imbalances. So domestically, we talk about the excess liquidity. The debt GDP ratio remains quite high by global standards. The mid-sized small lenders in China are constrained by the capital adequacy. They are burdened by pretty high level of non-performing loans and also funding pressure. So they're not in a capacity to lend much more than they have been. There are also a range of industries such as steel, real estate, and coal mining suffering from significant overcapacity. So that makes sense to inject more credit into those sunset sectors and to prop up zombie companies. So these are the challenges facing conventional fiscal and monetary policy. So it's not just simply a story of stimulating demand, but they also have to undertake far-reaching structural reforms to create the condition the economy can grow at a pace consistent with the potential growth rate.